Hi, I'm David Koch. A company's income statement tells the story of how a business has used its assets to make a profit over a defined period of time, usually 6 months or 1 year. It explains the change in the net assets a company owns between the start and the end of the reporting period. The income statement should be read in conjunction with the balance sheet, as the assets, which have a future benefit, are used up, they're expensed, their benefit is expired. Assets are acquired with the aim of generating revenue, and as they're used in the generation of revenue, they're expensed against that revenue. Today we're going to take a look at former childcare centre company ABC Learning's income statement, or to use its proper name, Statement of Comprehensive Income. On the income statement you'll find two important pieces of financial information: revenue and expenses from ordinary activities. In ABC Learning's case, its main revenue included the childcare fees it earned, as well as the revenue it earned from selling non-current assets, that is, assets that could be expected to earn income for the company over a period of more than 12 months. Non-current assets included things like the childcare centres themselves. ABC Learning's expenses included staff wages, as well as depreciation of non-current assets, amortisation of intangible assets, and losses like those recorded from selling non-current assets. The difference between revenue and expenses from ordinary activities is known as net income. ABC Learning's Statement of Comprehensive Income presents a picture of fabulous revenue growth and profit every year. The main revenue was from its childcare fees, with childcare fee revenue jumping from $12 million in June 2001 to revenue of $1.6 billion in 2007. From 2005 to 2007, it appears that ABC Learning's financial statements show it paid $1 billion for childcare centre leases and licences to an anonymous developer, and correctly recorded these costs as investment activities. That is, what you'd expect from a company in an intense investment phase that grew from having just 43 childcare centres when it listed on the stock market in March 2001 to having 2,238 childcare centres by 2007. However, it also appears that the same amount of money as it paid for its childcare centre leases and licences, $1 billion, was returned back from the same anonymous developer of the childcare centres, which ABC Learning recorded as revenue from operating activities. The impact of such a transaction would be to overstate revenue in the income statement, whilst having a zero net impact on total cash in the cash flow statement. If this was the practice that ABC Learning adopted, then this meant the income statement recognised revenue that had never been earned. This transaction isn't the only questionable revenue recognition entry ABC Learning made on its income statements. John Walker from IMF Australia suggested that the 2006 accounts show approximately $20 million of the $81 million it earned in profit that year was from revenue from a contract to provide staff to ABC-owned centres. You would then expect that the centres would recognise the payment as an expense incurred to provide staff to its centres. This is known as an intra-group transaction, which, under accounting standards, should be eliminated in the financial statements. But it appears that ABC Learning did not recognise the expense. Therefore, by not eliminating this intra-group transaction, ABC Learning would have overstated net income by 25% in 2006. As it grew, ABC Learning also made the mistake of failing to control costs, especially its staff costs. Until it started rapidly expanding its business in 2005, the company was able to maintain staffing costs of less than 10% as a proportion of fee revenue. But by 2006, ABC Learning had become so focused on earning top-line revenue from childcare fees, it took its eye off its expenses and increasingly started to use expensive agency staff in its childcare centres, causing staffing costs to jump to 68% of fee revenue. Now, let's take a closer look at the relationship between intangible assets and the income statement. There needs to be an active market for an intangible asset to be properly valued. The value of the asset on the active market will determine its value on the balance sheet. Any difference between a previously reported value of an intangible asset and its recoverable amount on the open market is known as a write-down and is recorded as an expense on the income statement. ABC Learning's main intangible assets were its childcare licences, which were recorded in the financial statements at $2.6 billion. The problem was, as by far the biggest childcare centre operator in the world, ABC Learning set the market price for childcare licences. There really was no open market. In 2007, the company's financial statements show there is no impairment associated with the licences and $1 million impairment for goodwill. But as there was no active market for childcare centre licences because ABC Learning was the market, the $2.6 billion the company recorded for its licences had no relationship to their real recoverable value. It's also worth taking a look at related party transactions in relation to the income statement. Related party transactions occur when a director of one company, let's call it Company X, buys goods or services from another company the director also has an interest in, which we'll call Company Y. There's no inherent problem with related party transactions. They're a normal part of doing business as long as they're properly disclosed. Proper disclosure of related party transactions avoids a perception of a conflict of interest between the two parties and gives other shareholders confidence the dealings between the two companies are all above board. ABC Learning's financial statements show that a company called Queensland Maintenance Services won $174 million in untendered maintenance contracts between 2003 and 2006. But what the accounts didn't show was that the registered office of Queensland Maintenance Services was the same address as ABC Learning's former Managing Director Eddie Grove's own address. Nor did the accounts show Queensland Maintenance Services was run by none other than Mr. Grove's brother-in-law. We don't actually know what sort of services Queensland Maintenance Services provided to ABC Learning, but not disclosing this relationship in the financial statements reflects poor standards of corporate governance at the company. Almost until the end, ABC Learning's income statements indicated the company was in robust health, with strong growth in fee revenue year on year. But its spectacular collapse in November 2008 suggests the company suffered not only from questionable accounting practices, but also that its recognition of revenue and the origin of its cash flows were extremely problematic. In 2006, a complaint was made to ASIC, the Australian Securities and Investments Commission, the regulatory body that questioned ABC Learning's intangible assets valuation and methods of financial reporting, that is, recognition of revenue. ASIC responded that they had inquired into the issues and would take no further action. 2 years later, the company had collapsed. The picture that ABC Learning's comprehensive income statement painted did not appear to reflect the true picture.